Now let's move on to the lifespan portfolio. So I want to talk about some of the changes we've made. We haven't done that much in the last quarter in the portfolios, and I think a lot of what we've talked about today isn't that new. We've had these views and these feelings about the bond market and equity markets for some time now, and as such, our portfolios are reasonably well, we like to think, positioned for that sort of an environment. One of the things we did do is we made a change to our emerging market equity manager. Now, we talked about just earlier having some diversification away from the US. So obviously investing in emerging markets is one way to do that, albeit a lot of these emerging market companies that these managers invest in do rely on the US for a lot of their earnings, but they definitely do give you some diversification. Now, so there is a valuation, and there's usually a valuation gap between emerging market stocks and US stocks and other developed world stocks. But we think it's particularly attractive at the moment. Jonathan, you've got some views on emerging markets. Could you share those with everyone?
Yeah, sure, Eugene. I mean, look, we've had some really good discussions amongst the team over the last, I think it's 3 to 6 months now, Eugene, isn't it?
Yeah.
We've had some really great discussions from, and contributions from the rest of the team and a discussion around emerging markets and looking at the relative valuations to obviously the United States and other developed equity markets. So the first observation is a simple one, is that emerging markets are trading at a valuation discount to their, to the comparative markets in the developed world. But as you just correctly pointed out, historically there's been a discount for a good reason, because emerging markets attach a higher risk premium because they are emerging markets. There's a volatility, there's a policy uncertainty dynamic to investing in emerging markets. And the other thing we talked about, I think we did at our last meeting, Eugene, was the observation that for the first time, well, certainly for the first time in my 41 years, and I think the first time in history, actually, in modern history, the actual risk premium around emerging markets, when you look at fiscal measures, that is debt levels, absolute debt levels, debt to GDP levels, the budget deficit to GDP levels, etc. Funnily enough, a lot of the emerging markets have much better fiscal ratios. We'll leave China out for the moment, but a lot of the countries that comprise emerging markets have better fiscal arithmetic than much of the developed world, because France is pretty much a fiscal basket case. I would say the UK is a fiscal basket case, and the United States is almost a fiscal basket case, and then Japan is without doubt a fiscal basket case. And yet, so many countries in the emerging markets have much better fiscal ratios. So the historical risk premium that we attach to emerging market assets versus that of the United States and much of Europe, much of that is dissolving. So that, I think, is interesting. When it comes to policy uncertainty, well, I'd say there's quite a lot of policy uncertainty in the United States. I'd say there's quite a lot of policy uncertainty in Europe. And then we look at earnings generation. Now, obviously, we've already had a long conversation around, that America is the strongest in terms of earnings growth, and that's being powered by these Magnificent Seven, and in particular, the Magnificent One. And there isn't really an NVIDIA type company in the emerging markets, although we could say Taiwan Semi is a pretty impressive company. That's certainly one of the largest members of the emerging markets. And then you've got a couple of Chinese companies like Alibaba and even BYD and Tencent. These are great companies. And then you've got India in the emerging market basket, which is very interesting. The banks in India look very exciting. Yes, they're on reasonably expensive multiples, but for good reason, because banking in India is a growth market. And then you've got the India story, which we have all believed in for a while. So there's some really nice kind of tailwinds to these emerging markets, and you've got obviously that very large valuation discount. I think on a PE basis, there's at least a 9-point discount investing in emerging market indices or emerging markets. So net, we wrap that all up together. You can make a reasonably powerful case for an allocation to emerging markets. And moreover, when you consider the major global institutions have been largely underweight emerging markets because, of course, the United States has been, in pole position, it's got all the attention and got all the capital, and it's risen as a proportion of the overall global equity indices. And I do know that a number of big global asset allocators, particularly in Europe, are somewhat anxious about having too much invested in the United States and are looking for opportunities to diversify away some of that American risk in their global portfolios. And you're seeing in the last few months some of the big managers saying, hang on a minute, emerging markets have underperformed the United States dramatically in the last 10 years. In fact, it's slightly more than 10 years. And now maybe this is the time for emerging markets to shine in a relative sense. And they're incrementally allocating to emerging markets to diversify their portfolios and mitigate what they see as being excessively concentrated US equity risk. And given the conversation we just had, where we can see objectively that all the valuation measures in the United States are right up there, stretching the top part of the chart on your screen, and the emerging market valuation measures are way down the page in a relative sense. So I think there's a reasonably powerful, compelling, fundamentally based
Manager is extremely important.
Yeah.
Emerging markets, because the different countries and companies within those countries that you can invest in is enormously vast, and they all carry from country to country quite different risks. So that's an important part of the puzzle. That's the only real change we made. I will mention, though, that in light of our view of long-term yields or long-term fixed-term yields, we are relatively underweight long-term duration fixed-term bonds, particularly overseas. So we've got most of our bond exposure in Australia. We do have some overseas, and I would say those risks that we spoke of are less so in Australia because our fiscal situation is much better than in the US and Europe. So without going, we've talked a fair bit about bonds. So without going too much into that, we've got a lot of high quality credit in the portfolio, which doesn't have any significant duration. We've got a fair bit of cash as well. We do have some duration because at some point long-term yields could come down, particularly if interest rates keep falling. But at the moment, long-term bond yields are sort of anchored, and they're not coming down, even though short-term rates are being cut. Anything to add to that, JP?
No, I wouldn't really, other than to emphasize the observation, Eugene, you just made, is where the fundamentals for the Australian bond market are better than for the United States or Europe or Japan. Our fiscal ratios are so much better looking. And as a result of that, you can make a much more compelling argument for Australian government bonds than you can for Europe, the United States, or Japan.
Yeah, which is which is represented in our portfolios.
Yeah.
So that's good. The other point I wanted to make is that over the last quarter, and perhaps even a little bit longer, our Aussie equity managers in the portfolios have underperformed a little bit by not holding the Commonwealth Bank, which is becoming a bit of an enigma. And I think one of the main reasons they've not held the Commonwealth Bank, or sorry, either they've not held it or they've been underweight it because it's such an enormous part of our index. It's fallen about 10% in the last week or two in value, but it's still north of 10% of the S&P 200 index. Now, Jonathan, I know you've done a bit of analysis on this because you and us have been watching the valuation of CBA just continue to balloon. And care to share some insights on the Commonwealth Bank, the enigma that is the Commonwealth Bank of Australia?
Yeah, you've summed that up beautifully. Look, as you know, Eugene, we've had conversations about this, but I know you also very, very kindly read my report every weekend as well, and you'll know that every now and then I get a bee in my bonnet about something. Fortunately, I haven't had too many bees in my bonnet in the last couple of years. I got a bee in my bonnet about inflation in 2021 and blah, 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 and you know all about that. But more recently, I got a bee in my bonnet about the valuation of CBA. CBA is officially the world's most expensive bank. So CBA trades on a price to book multiple in excess of 4 times, whilst at the same time, return on equity has been declining inexorably in the last 5 to 7 years. So the valuations just don't add up. Now, I don't know if this is the right forum to tell everyone why CBA is where it is. But the bottom line is, let's just say this. The Australian industry funds have been buying a lot of CBA in the last 12 to 18 months. And you know what is curious, even more curious, is that as the return on equity declined, you saw this parabolic move in CBA. So it was just not fundamentally driven. Now, we just saw the results for CBA, and they were cosmetically okay. But at the end of the day, this is a bank that is not exactly growing earnings in any kind of material, robust way. On a price to book ratio, which is one of my favorite valuation measures for banks, and I use that comparative measure again across all the world. And you've got the JP Morgans of this world that are great banks, but they're not trading anywhere near the multiples that CBA are. So the bottom line is it's just damn too expensive, full stop. But every banking analyst in Australia has said that now for quite some time. And their price targets on CBA are around the 115, $110 mark. I don't know where it is trading as we speak because I've tried not to look at my price screens on my other screens away from this camera. But the bottom line is CBA is very expensive. Yes, it's just fallen 10%. But if it went to anything approaching fair value, let's be kind, just in case there's an employee of CBA listening to our discussion. If I was really generous to CBA, it would be around 125 is probably where it should trade. There's some of the world's best banking analysts say the thing is not worth more than $100. Anyway, every Australian pretty much has some exposure to CBA because, as you say, it's such a large part of our market. It is an enigma. That's a great word to use. From a valuation perspective, it doesn't make any sense whether that is spelt with an S or a C. So CBA is the most expensive bank in the world, and it just should not be where it is. And the Australian industry funds should stop buying CBA on a daily mechanical kind of robotic basis and actually look at its valuation.
Okay. Well, that's interesting. But it is, yeah. But given how big a part of the index it is, it does carry weight as to the performance of an active fund. But anyway, and we're sort of comfortable with that position because, we want diversification and we don't expect our managers to outperform all the time. But I thought that might be interesting. So to summarize, the other important part of our portfolios where we're trying to get some diversification away from US equities and equities generally is we've got a decent exposure now to listed property and listed infrastructure. Those asset classes tend to do well in an inflationary environment. They probably don't like when interest rates are going up, but when interest rates are coming down and or if you've got a stagflationary type environment, which you could argue that we're in at the moment, they tend to do reasonably well, and they're a good diversifier away from companies. And we've talked a bit about data centers. They do invest decent amounts into data centers because that is seen as infrastructure, and in some global property indexes, data centers are included in that investable universe as well. So we've got a decent exposure there as well. And then just to sum up, our strategic portfolios remain underweight growth, but not too underweight. And we increased that a little while ago, but we haven't increased it recently. But we do remain underweight, and that's part of our cautious positioning. But if you look at our performance, it's still very, very healthy. So we've been outperforming our peer group benchmark in the balanced and I think in all the asset classes. So we're getting a little bit of extra exposure in the small cap space, in the emerging market space, and that's boosting it a little bit, as well as just our general asset allocation. On the tactical side, we also remain underweight growth and equities, but we have been drip feeding into growth assets over the last 6 to 12 months, which has continued over the last quarter.